For the past year, the financial media has been telling you the exact same story. They want you to look here and absolutely anywhere else, except for the one place where the global financial system is actually starting to tear at the seams. Because the biggest risk to your stock portfolio, your ability to buy a home, and the stability of the US dollar isn't a tech bubble. It's a boring 30-year-old promise made by a central bank on the other side of the planet. For decades, Japan did something radical. To fix a broken economy, they made the cost of borrowing money practically free. Actually, less than free. They pushed interest rates below zero, and in doing so, they accidentally became the world's ultimate ATM. Trillions of dollars quietly flooded out of Tokyo, acting like financial oxygen, inflating everything from Silicon Valley tech giants to American suburban real estate. This free money machine was the hidden duct tape holding the global financial system together. But right now, that duct tape is officially peeling off. In mid-2024, the world caught a terrifying glimpse of what happens when this machine stops, causing the worst single-day crash in Japanese history. It was a warning shot. The math that ran the global markets for 30 years has flipped. The financial oxygen is being sucked out of the room, and most investors are staring at the wrong lever. It's time to brace for impact. Meet Ken, a professional institutional investor. He's always searching for the next big opportunity to maximize returns in the complex world of global finance. Our story begins in Tokyo. For years, the Bank of Japan has kept interest rates near zero, specifically at 0.1%, to stimulate their economy. For Ken, this isn't just a low number, it's an invitation. In Tokyo, money is practically free to borrow, but there is no yield. Now, look across the Pacific. In the United States, high inflation has forced interest rates up to a much more attractive 4.5%. This massive interest rate gap is the secret sauce of the yen carry trade, a loop that moves trillions of dollars across the globe. Ken starts the cycle by borrowing 1 billion yen. Because interest rates are so low, his cost to borrow this fortune is almost nothing. He immediately takes that yen to an exchange window. He sells the yen and buys US dollars, preparing to invest in the American market. Now, Ken invests those dollars into US Treasuries. Instead of earning 0.1%, his capital is now generating a steady 4.5% return. The math is simple. 4.5% yield minus 0.1% cost equals a 4.4%. Pure profit margin for doing almost nothing. But Ken isn't the only one. Thousands of investors have turned Japan into the world's infinite interest-free credit card to fund their ventures. This flood of cheap yen fuels global growth. It pumps liquidity into tech stocks, venture capital, and even luxury real estate in major cities. From Nvidia to Apple, much of the recent market boom has been supported by this massive, invisible flow of Japanese-funded capital. However, the carry trade relies on one fragile assumption, that the yen stays weak and interest rates stay low. If that changes, trouble follows. As we look toward the future, the global economy sits on a house of cards. One sudden shift in Tokyo could send shockwaves everywhere. In early 2024, that fragile assumption didn't just bend, it snapped. And the shockwaves sent a clear message to Wall Street. The party is over. Chapter 2. The Snap. The Death of Free Money. For 3 decades, Japan's biggest economic problem was deflation. Prices simply wouldn't rise. But the post-pandemic supply chain shocks and soaring energy costs changed everything. Global inflation finally breached Japan's borders, forcing a shift in policy. The Bank of Japan was forced out of its defensive shell. In a historic pivot, they did what many thought was impossible. They ended negative interest rates and dismantled yield curve control. For the first time in 17 years, the cost of borrowing yen began to climb. While a 0.25 percentage point hike sounds tiny to the average consumer, to macro investors, it was a nuclear launch code. Let's look back at Ken's math. Remember, Ken's entire business model relied on borrowing at near-zero costs to fund global investments. As Japanese yields creep up, two things happen simultaneously. Borrowing in yen becomes more expensive, and the cost to hedge currency risk skyrockets. Suddenly, that beautiful 4.5% spread on US debt begins to vanish. The math completely flipped. The trade was no longer a guaranteed win, it was a ticking liability. This triggered the Great Unraveling, a massive wave of capital repatriation. Japanese institutions and global hedge funds didn't just stop borrowing yen. They had to rapidly sell off their foreign assets to pay back loans. The world saw exactly what this looks like during the chaotic market unwinding event of August 2024. In a matter of days, stocks freaked out. The S&P 500 tumbled. Tech stocks experienced massive intraday liquidations, and Japan's Nikkei index suffered its worst single-day drop since 1987. It was a brutal display of systemic vulnerability. But here is the terrifying truth. That crash wasn't the finale. It was just a dress rehearsal. Because the unwinding of the carry trade creates a structural vacuum in the single most important asset class on Earth, the United States bond market. For decades, America relied on a silent, price-insensitive buyer to absorb its multi-trillion-dollar national deficits. Japan was that buyer. If the world's largest net creditor nation decides to take a step back, the cost of money changes everywhere, for everyone, permanently. The party hasn't just ended, the foundation is shifting. Prepare for Chapter 3, where we explore the new global reality.